For the first time since 2020, the Federal Reserve cut its benchmark interest rate last Wednesday by a half a point, a cut that economists say is sizable.
A lot of analysts were expecting that the Fed would cut interest rates, but most of the expectations were that it would be a quarter point. And so the fact that it was half a point, I think, was a little unexpected.
Elmira College economics professor Mariam Kawar explains the Fed makes a rate cut once the economy's inflation rate slows to just over 2% for a slow, steady economic comeback to prevent volatility.
There seems to be enough softness in the economy that the Fed can feel that inflation won't creep back up.
Economists have anticipated a rate cut since August when the interest rate finally fell to 2.5%. Now that the rate has been cut, what can consumers expect?
All borrowing costs, right? They should decrease. It's possible that we could see lower rates for car loans and credit card borrowing and things like that, all of which should help consumers.
A recent Harris poll and NerdWallet survey found 15% of Americans said they'd buy a home once interest rates decreased.
Mortgage rates have already come down because they were factoring in the rate cuts. They were anticipating the rate cut. So mortgage rates have come down since, like significantly since May.
Fed Chair Jerome Powell said up to two more rate cuts could happen by the end of the year, which means mortgage rates could continue to drop or stay the same.
At which point maybe people will say, okay, well, I can't wait any longer. And start buying homes.
But it could take up to a year before people really feel the rate cut in their wallets.
It's typically like 6 to 12 months before a lot of rate changes are felt. They kind of trickle down and actually affect what's going on.
The next Fed meeting is scheduled for November 6th or 7th, right after Election Day, and could result in another rate cut. Sonia Ellison, Big Fox News.